Hi everyone, welcome to the third part in the series of topic explainer videos for performance ratios. In this particular video, we are going to talk about solvency ratios with respect to the financial reporting exam. I am your expert tutor Aleena Kareem and I will be doing a debrief of the formulas which are going to be used for the solvency ratios and what do the changes in ratios mean. In the end of this video, I'm going to talk about how you can attempt the exam with respect to ratios and what are the do's and don'ts shared by the examiner for overall interpretation related questions. So let's start with our discussion. Within the performance ratios, we have already covered working capital in one video, liquidity ratios in another video, and here we are with the solvency ratios. Solvency ratios are also related to the liquidity. So these are related to the long-term liquidity of the company. We just covered extensively the short-term liquidity of the company, but these are related to the long-term liquidity of the company. Again, two ratios are very important. So I've included them in this particular topic explainer video. And these are gearing ratio and interest cover. These are both very important, so we are going to discuss them individually. Now, starting off with gearing ratio. Gearing ratio is something which has two different formulas, so it can be calculated either simply as debt divided by equity, so it can be debt equity ratio, or it can be calculated as debt divided by debt plus equity. So in the denominator, there is this whole financial structure of the business, debt plus equity, and in the numerator, there is only the debt part. Now, let's see what the individual aspects of this gearing mean, and then we'll discuss how it has been tested in the past exam papers. So, basically, the gearing ratio, it indicates the proportion of a company's capital that is financed through debt. So it relates to an organization's relative levels, actually, of debt and equity, and it can help to measure its ability to meet its long-term debts also. These ratios, they are also called at times risk ratios or positioning ratios. However, the most commonly used term is actually the solvency ratio. So over here, when you talk about high gearing, it at times suggests a riskier capital structure. Why? Because higher gearing actually means that in the overall capital of the company, the level of debt is higher. And lower gearing in general indicates lower risk. Why? Because with the debt, a fixed amount of interest payment and the principal repayment is associated. However, with respect to equity, the return that is to be given is discretionary, as well as there is no obligation to pay the actual amount of investment. However, just having a company focused on debt or just having a company focused on equity, that's not okay, because ultimately, in the long term, equity becomes a more expensive source of finance. So over here, there are multiple things. Gearing may result from higher debt levels, or maybe there is a reduced aspect of equity also. Now, in case of, while we are talking about the reduced level of equity, it may be due to any kind of dividend payment or any losses that are happening in a business. So we are over here examining the overall financing structure of the business. Anything which is related to the debt levels or the equity levels, they are going to be evaluated over here. Why is this ratio important? That's a very important part. Now, because it measures the overall proportion of debt to equity, this indicates to the shareholders the degree of risk that is attached to the company and the sensitivity of profits and dividends to the changes in the profitability and activity level. Why? Because the interest payments on debt and the principal repayment of debt is a legal obligation. So that is going to be made first, and then the equity holders are going to be rewarded. However, if ultimately, the debt is going to be repaid, but equity is going to remain there till the company sustains. So overall, in the long term, it is a more expensive source of finance. Gearing can also decrease due to debt payments or right issue of shares. So please remember, due to bonus issue of shares, there is no change because there is no increase in equity because of it. But if there is a new issue of shares, equity is going to increase. Equity is also increased by the revaluation gain aspect. So while you are analyzing the ratios, you need to see whether the increase in equity has been because of anything which resulted in an increase in injection of cash in the business, or was it because of an unrealized gain? Now, over here, you can see asset revaluation increases equity, reducing gearing, but it raises depreciation, affecting operating profit margin and gross profit margin. So once again, increase in asset revaluation. It's not just one aspect. It's going to impact your gearing. It's going to impact depreciation, which is going to impact the profit margin, which is going to impact the gross profit margin and the operating profit margin. They are going to impact the return on capital employed. So one figure changing has so many impacts. And when you are solving the question, identify all those impacts. Now, one more thing over here is that off-balance sheet finance, it may understate any debt. However, this issue has been reduced since IFRS 16 has come up, because now almost all the leases need to be disclosed on the face of statement. However, if the company is using any such technique, then the gearing ratio might be manipulated. Now let's see how gearing has been tested in the past exam papers and how the examiner has provided the solution to it. So over here is the first example. It says that there was a gearing answer. This makes Fit Company a riskier business than Sporty Company, as it must meet these debt repayments or would face insolvency. So over here, Fit Company had a higher level of gearing and Sporty Company had a lower level of gearing. So risk is higher because they need to make the debt repayments, or otherwise they're going to face insolvency. As the gearing for Sporty is much lower than the Fit Company, Sporty Company should be able to secure debt finance if needed for its planned international expansion. Now, this was a very interesting point. They had mentioned in the question that the Sporty Company is looking to expand the operations. So automatically you link this point to gearing, that they have a good margin that they can get debt finance. A company which is already struggling with the repayment of its previous debts, for it to get more finance is difficult. But for a company which has a low gearing ratio, for that it's easier to get loans from the banks. Fit Company will incur much higher finance costs on its debts than Sporty Company, which is equity financed. Both companies are currently covering interest payments from operating profits. However, the cash balance for Fit Company is much lower than Sporty Company, which implies further pressure because of the interest payments. So once again, as I mentioned earlier, interest payments are obligatory. Dividend is not obligatory. So if a company is struggling with cash flows, they may not give dividend in a particular year. However, if they have a debt, they have to make the interest payment. The current year interest payments for Fit Company exceed the cash balance at the year end. Therefore, Fit Company must ensure that its cash interest payments are sustainable in the long term. Again, this links to the current ratio aspect also, that any short-term payment that is due, that needs to be met from the current assets. Another example of another question, it was Bun's Company. We've discussed it in an earlier example also. It said that Bun's Company's debt to equity at 44.6% is lower than the sector average of 80%. Fine. It seems that the sector overall is much highly geared. So this has a lower debt to equity ratio. This could be because Bun's Company acquired its property, which has no associate finance. This also means that there will be smaller amounts of interest charged to statement of profit or loss, but this is difficult to confirm as the extract provided is only the profit from operations. So there was an extract provided, there was a property purchased. It was not mentioned that to purchase that property, the company had taken a loan. So the second line was mentioned that there was no associated finance. There is a bank loan of 14.4 million. And although the bank loan interest of 10% might appear quite high, I've specifically highlighted this area for you. See, this is a beautiful way of linking the loan interest rate and the overall return on capital employed, that there has been a bank loan of 14.4 million, and although the bank loan interest rate is 10%, which might appear quite high by the general standard, it is much lower than the return on capital employed of 26.9%, which means that shareholders are benefiting from the borrowings because the return overall on the capital employed is much higher than what the interest is being paid. So this means that the remaining benefit is being enjoyed by the shareholder. So this was a very interesting point. Very few questions have covered this, so I particularly included this over here, that this is how you are going to create the linkage between the different figures. And that is what is going to get you maximum marks in your answer. Finally, Bun's company also has sufficient tangible non-current assets to give more than adequate security on any future borrowings. Therefore, there appears to be no adverse issues in relation to gearing. So every ratio mentioned in the question is not going to have a problem. If there is something positive, you need to mention that also. Another example of gearing, it's a popular ratio which is tested, so I included more examples. The gearing has reduced in the year from 36.1% to 33%. This is not due to reduced level of debts, as these have actually increased during the year. Now, the levels of debt have increased, but the gearing has reduced. So if the debt has increased, but the gearing has reduced, what does this mean? Only one thing, that there has been an increase in the equity also. So this is likely due to the consolidation of debt held by Smooth company, as Duke company has not taken out any additional loans. So one company had gone and acquired the other company in this question. So they say that the parent company has not taken any loans, which means that the higher debt figure is due to the inclusion of the debt of the subsidiary company. This increase in debt has been offset by a significant increase in equity, which has resulted from the share consideration given for the acquisition of Smooth company. Now, once again, a very interesting point. Now, generally speaking, if we see, okay, one company is going and acquiring another company, so automatically it comes into our mind that yes, assets and liabilities are added on a line by line basis. So the liability or the loan of the subsidiary company is going to be added to the loans of the parent company. However, the equity is shown of the parent company only. So why is there a change in the equity? Now, this was the point over here, that the company had made a share for share exchange. So to acquire the new company, they had issued new shares, and this was a consideration, and that increased the equity also. So different aspects, there are different ways in which questions are tested. You need to practice most to be able to handle these questions easily. Let's now move on to the interest cover. Interest cover has the formula profit before financing and income taxes divided by interest expense. Again, we are dealing with a numerator which has been picked up from your statement of profit or loss, talking about the profit calculated before financing and income taxes. And it is divided by interest expense. So in the numerator, expense has not yet been subtracted from the profit. Interest cover shows how many times a company can cover its interest expenses with its profit before financing and income taxes. It shows the strength of the company, how much profit they have earned, and what is their capacity, how many times can they pay the interest expense if it arises. The higher the number, normally the better it is considered to be. However, normally a figure of 4 times is considered to be good, and something less than 2 times is considered to be a dangerous zone. But it is not something which is fixed. It varies from company to company. It varies from industry to industry. So please note in your question what the comparative figure is, and then based on that provide your analysis. So a higher value indicates a better financial health and less risk. If the company wants to do more borrowing and they have a high interest cover, they can easily meet the expense which is going to arise. And also it is something in which the shareholders are also going to get their share after the deduction of interest expense. If the value is very low, then it may suggest some potential difficulties in meeting interest obligations, and therefore, if the interest is at stake, the company has a legal obligation to pay the interest expense. Therefore, they are going to go for that payment first, and if only the profit is left behind, then the shareholders are going to get dividends. If the interest expense is too high, then a priority will be given to payment of interest and nothing may be left behind shareholders. Then a decrease can occur in interest cover because of two reasons. Either the numerator is decreasing, which is the profit before financing and income taxes, or the denominator may be increasing. Now, in such cases, if the interest expense is rising, it may be due to higher rates. If the company is already struggling with financing its current debts, getting a new one may become an even bigger challenge and the rates might be very high. Or even if the same rates are being applied, the company taking new loans also means that it is going to impact the interest expense. In your questions, also remember, if the question is showing that the loan was taken during the year, within the current year, there may be impact of expense for only half a year because it was taken somewhere around mid of the year. But please remember that next year, there is going to be a full year expense to be charged to the statement of profit or loss. In such case, it needs to be identified what the current interest cover is and how it is going to change in the future. So you have to tell the future implication also for the company. This is something which is going to make your analysis more meaningful. Some examples related to interest cover which have been there in the past exam papers. So it said that the interest cover has declined in the year. I'm reading the first example for you. So interest cover has decreased. Now let's see what were the reasons for it in the current year. It says that there has not been an increase in interest costs. So this means that the denominator was the same, which means that a decrease can only happen due to a decline in the numerator, which is mentioned. So this is due to a decline in profits. Now this is something which is very specific to the scenario. If within the same answer, you just simply write that maybe it was due to an increase in interest expense, when the question was clearly showing that there was no change in expenses, you're going to lose marks for it. So your analysis should be very specific to the scenario at hand. Let's read the remaining part. It says that this worsens further when Holloway Company is excluded. There was a disposal during the year for this Holloway Company, and the Holloway Company was performing better. It had a better interest cover on its own, and because of low interest and relatively higher profit, overall company's interest cover was better. Now that Holloway Company is no longer going to be there, in the future, the interest cover has a further risk of getting lowered. Over here it says that Holloway Company not only generates higher profit than the rest of the group, but has lower interest expense at 1.9 million out of the total of 4.9 million. So you see the approach that we have discussed before. Also, I'm going to repeat it for you shortly, that you state what the change is, you apply it to the scenario, and then you tell the future implications also with respect to conclusion. Taking the second example now, it says that the interest cover has increased from 2.5 to 5.3 during the year, which is a combination of both an increase in profit before financing and income taxes and a decrease in interest expenses. So in this particular example, both numerator and denominator were changing. So that needed to be highlighted. The interest expenses are likely to have decreased due to the exit from the lease. There was a lease during the year which had ended and there were no interest expenses related to that lease now. So that's a very scenario specific example which can be there, and it can be mentioned that because the company is not planning to have any lease in the future also, that this figure may remain the same. If the company is planning otherwise, then also you should state it. Let's see one more example. Initially, the interest cover has shown good improvement in 20x7 compared to 20x6, as there has been a significant increase in profits, even with the profit on disposal stripped out. So the interest cover has improved, and what is the major reason for it? The profits have significantly increased. Then it gives an example of a one-off item, which is even with the profit on disposal stripped out. It shows that there was a profit on disposal during the year, which may have increased the overall figure of profit before financing and income taxes. However, the question also implies that even if you remove that profit, because that is not going to be there on a recurring basis in the future, the interest cover will still be healthy. This will ask you for a further calculation. So you need to calculate again that without this profit on disposal, what will be the profit and then what will be the interest cover. So giving a future implication also that this particular item is to be included in my future profits. That is something which gives a forward approach to the examiner and shows that you have done a good analysis. This was one example of a non-recurring item. Always look in your question for any items which just happened in the current year and they're not going to be there in the future. You can use them for your analysis. Then it says that following the removal of Swanson Company, the interest cover is removed further. Over here, there is a disposal, but then the company which has been removed maybe was struggling with the interest cover. So its removal has actually had a better impact on the overall performance of the group. This may be because the disposal of Swanson Company has allowed Perkins to repay debt and reduce the interest expense incurred. Now, this is what the examiner is looking for. So far, we were talking about some of the generic points other than the profit on disposal. So one thing was that maybe removal of Swanson Company means that the overall impact in the performance that has been removed, and if their interest cover was high, they may be masking the overall performance of the group. Now that it is no longer there, the interest cover may be better. And also, the company has received cash on the sale of Swanson. So they may have used that to repay their debt and reduce the interest expense. But this point also you cannot write generally. Go back to the statement of financial position, see if the liabilities have decreased from the previous year. If that's the case, then you bring it over here and discuss this particular point. So this is something which makes a really good analysis, that you continuously apply all the information from the which can be picked up from the scenario. So a quick revision of the technique that I have discussed in the previous two videos also, that while attempting the exam, use the approach state, tell the change that has happened, apply it to the scenario, pick up the points from the scenario. When you pick up the points, they are mostly going to be from the additional points that are written in theory. But to support those points, you need to go back to the financial statements and see if there are any changes in the figures also which are significant and which need to be used in your analysis, just like we did for the repayment of debt. And lastly, conclude, show that if a disposal has been done, the profit is not going to be there in the future. If their interest cover was bad, that is not going to be there in the future. So give a forward-looking approach also to the examiner. For every ratio, you need to follow these 3 steps. If you follow those, you have comprehensively covered everything that your examiner requires for giving you a full mark in this question. Now, this was all with the ratios. I wanted to discuss quickly a few examiner feedback points that have repeatedly come up, and I want you to focus on these. I've covered them in my video throughout, but I wanted to highlight them again in a summarized way, that please see that the examiner repeatedly says that the students do not show workings. Please show the workings of the ratios that you're doing, because even if there is an own figure rule that the marker can give you a leeway with and give you extra marks because of it, if you don't show the workings, you're not going to get them. Then there is insufficient analysis. A lot of students just show the calculations and don't show the analysis. This is very important. You need to show the analysis You need to link it to the scenario. Once again, lack of scenario usage. The students give generic answers, generalized analysis. They do not link it to the scenario. I've particularly included these examples that I did from the past exam papers to show you that the examiner is not giving even a single generic comment. They are all linked to the scenario, and that is what is going to get you marks. You are at the financial reporting level. You are at the applied skills level. No generic comments are going to get you marks. And lastly, there is an inadequate linkage in the ratios also. So once again, link your ratios to each other and to the figures in the financial statements also. A quick round of exam tips discussed before, but I wanted to summarize them for you for your reminder. Use the scenario, use it wisely. Your scenario is your best friend in your exam. So use it. Every single point that is mentioned in the scenario, that's going to impact your answer. Mark my words. No extra information is given in the question. So use that. Structure the response based on the requirement. Identify whether the question is asking you to comment on the performance of the company, on the position ratios. Identify what the question is asking and then write the relevant answer. Any kind of variation, mention the variation with respect to the standard which has been given for comparison, whether it's industry average or it's a competitor company or it's past performance. There are multiple scenarios that can come up. There can be a comparison of a single company with consolidated accounts, consolidated companies for 2 different years, anything. So identify that and analyze the impact on all the ratios, on all the, whenever there is a change, identify how it's impacting everything. A simple disposal, we saw, it impacts so many things. It impacts the profit, it impacts the cash, it may impact the gearing ratio, it may impact the interest cover, it may impact the current ratio, it may impact the quick ratio. So all of that. So identify and touch upon all the possible ratios. Identify the obvious reasons first. What are the reasons? What are the obvious reasons from the scenario which are there for that change in ratio? And then you can say that maybe there is a possibility of this also happening. So don't just give possibilities. Identify from the scenario what is actually happening and then structure your answer accordingly. And lastly, if the question is asking for it, provide solutions and the actions that are there. Now, this is all with our topic explainer video for 3 different types of ratios. This is the relevant syllabus reference. You can go through it to identify what are the possible ways in which the question can be asked. Your interpretation questions, the ratios that we discussed, they can come up in section A, B also. 2-mark question asking you about one ratio, reason for change, formula, anything. So be prepared for that. Or you can have a CR question which is focused on the overall long interpretation of financial statements. Now, with this, we come to the last part. Please focus a lot on practice because just learning the formulas is not enough. Do written practice, do time-managed performance, and actively read the solution to identify how the situations have been tackled over here. And this is my final tip. Practice, practice, practice a lot so that whenever you get the scenario, you already know, your brain works in a way that you identify what are the common issues. At times, the issues do get repeated also, and you are able to write the answer accordingly. In fact, let me give you an example of it from the practice platform. Let's move to the practice platform and see how the questions have been provided over there. Now, over here, this is a past exam paper question. You can see treats company. It is telling you in the very first line what the nature of the company is. Why? Because it matters. It impacts the ratios. Then certain ratios for the sector have been given. Current ratio, inventory, turnover period, gearing, receivable collection have been provided. The financial statements are there. Then there are a few points also which have been mentioned which are going to impact. And just a quick look at the solution also. Let me just increase the size so that you can easily see it. So you see over here that the comparative ratios have been calculated, and then the answer has been divided into performance ratios and the position ratios. And then it is discussing each and every point and providing a conclusion also. It is talking about current ratio being significantly lower, maybe due to significant overdraft. Then a lot of cash tied up in inventories. They are talking about large volumes of goods to meet the supermarket contracts. Inventory holding periods discussed further. They are talking about the kind of items, perishable items that they are dealing with. So you see, whatever we have covered, same kind of things are being tested over here also. Receivable collection period, they are talking about it. And again, they are linking it that in case of a supermarket, the contract might be much larger. Then most of the sectors sell goods through their own stores and they're likely to be in cash. And then in such cases, the receivable collection period, that may not be a very big problem. Gearing ratio is significantly higher than the industry average. And then they are linking it with the cash position also. This is likely to need investment in non-current assets. The question had hinted upon the non-current assets, and they have highlighted that it may be difficult to get further debt because they're already in such a position. The gearing is very high, so it's difficult to get more loans. So they're saving up their cash because they want to use it for their investment also. Large dividend payment is questionable because the company was already overdrawn and the directors still went away and gave the dividend also. So this is how the questions normally look like. That was the practice platform for you. Now we have touched upon all the possible resources that you can use. Study Hub also has a lot of interpretation questions that you can attempt. So practice a lot, manage your time. And this is all from my side. I hope you found the video useful. Please go back to it, listen to it again, the points that you are struggling with, pause, learn again, and apply them to the scenario. I've tried to keep the video as practical as possible, and I hope this will help you in your final preparation. Best of luck for your financial reporting exam. Thank you so much.